Grab a dollar bill and a stick from your backyard. Physically, there is zero difference in their intrinsic value. They are both just pieces of matter. That piece of paper has purchasing power because of a shared societal agreement. We collectively agree to believe it is worth something. This same mechanism applies to modern digital assets. A Bitcoin holds value for the same reason that dollar does. A global network of people trusts the system behind it. Because most of us misunderstand this, we treat cash like a physical treasure. We think the goal is to pile it up, lock it away, and play defense. Hiding your money is a guaranteed way to lose it. To actually build wealth, you have to abandon the hoarding mentality and learn the 5 invisible rules of this trust-based system. Banks operate as financial matchmakers, connecting the supply of cash with the demand for loans. When you deposit $1,000, that money doesn't sit in a box. Through fractional reserve banking, the bank keeps only a tiny percentage on hand and immediately lends out the remaining $900 to someone buying a jet ski. The bank pays you a fraction of a percent to hold your cash, while charging that jet ski buyer a steep premium. They pocket the difference. If your funds are just sitting idle in a checking account, the bank is actively deploying your capital to build their wealth, not yours. Rule 2 introduces the silent eraser: inflation. This is the mathematical reality that your cash slowly loses its purchasing power over time. A $5 bill is still $5, but years from now, that same exact piece of paper will buy you fewer packs of instant noodles than it does today. This happens when consumers have cash, but there's limited supply. If factory lines stop and products become scarce, businesses raise their prices. Stashing your cash in a shoebox or a zero-interest account guarantees a quiet, continuous decay of your future buying power. Rule 3. You have to pay the cost of civilization. Imagine trading physical labor for a $2,000 paycheck, only to receive $1,400. Invisible forces take a chunk before you touch it. Part of that missing money goes to Social Security, which is essentially the government forcing you to put away a percentage of your income for your own retirement. Another portion funds Medicare, a specific tax dedicated to providing health insurance for the elderly and those with serious medical needs. These societal costs are permanent and unavoidable. Any valid strategy to get ahead financially must mathematically outpace this continuous drain on your income. Rule 4 introduces the trust algorithm. A credit score doesn't measure how much money you have in the bank. It is an algorithm lenders use to determine how much they can trust you. You can live completely debt-free and still have a terrible credit score, simply because you have zero proven history of handling borrowed money. This gauge shows the standard credit scale. Dropping below 580 marks you as a high-risk red flag, but if you optimize your payment history, that needle shifts into the green zone above 750, unlocking the best borrowing rates. You have to strategically interact with debt to prove your reliability. If you avoid the game entirely, the system punishes you with extreme financial friction every time you try to buy a house or a car. Finally, Rule 5. Interest is the price tag for renting someone else's cash, and time serves as its ultimate multiplier. Miss a 20% credit card payment, and your interest starts earning its own interest. That is how a simple $12 burrito spirals into a $50 debt. This chart shows the exact opposite effect. By securing a 7% annual return, your money starts duplicating itself. An initial $100 investment curves sharply upward, growing exponentially over the years. Interest is either your worst enemy or your best unpaid employee. The difference lies entirely in whether you are paying it or collecting it. If you let your cash sit perfectly still, the financial machine will actively use it and devalue it for someone else's benefit. The defense is simple. You have to kill high-interest debt immediately to stop the math from compounding against you. The offense is trading your cash for ownership slices of companies that provide significant tangible value to the world, like when millions of people traded their cash for the utility of the first iPhone. Capturing wealth also comes from investing in perceived value. Brands can charge a significant societal premium simply because people collectively agree the logo is worth it. Standard utility items sold in everyday retail stores without that premium perception do not generate those same outsized profit margins. Executing this strategy requires decades of patience. You are planting seeds, allowing consistent investments to take root and multiply year after year. Building lasting wealth doesn't require lottery luck. It just requires learning the rules, utilizing time, and forcing the financial machine to finally work for you.